Hey there, dividend growth stock investors. It's Colby, the DGI Crab, coming to you with a video that is part of an email back and forth that I had with a viewer. As you may know, making content based off of questions from viewers that are emailed to me at dgicrab@yahoo.com is one of, if not my favorite type of content to create. I want my channel to be interactive where I can maybe teach you all a few things. You can give me some perspective as well, and we can make ourselves better dividend growth investors over time. Now, I'm not a licensed professional financial advisor, and this viewer certainly isn't paying me anything for this. So the opinions you're going to get are just the opinions of this one crab. But as the viewer requested, I keep my viewers' names anonymous, but he did say that I could feel free to use his nickname Goose, and that if I did a video response, just take it as a crab and a goose just chilling on the beach shooting the shit. So here we are, we're on the beach, just a crab and a goose, and all of you other creatures of any kind out there are free to pull up a log or a lawn chair and kind of listen in. So had a really great back and forth here with Goose via email, and there's certainly enough content that I wanted to provide this video response, because we're going to go over Goose's portfolio that he's got in a traditional IRA. And I'm going to give him my feedback as to what I'm seeing there, and basically just what I would do if I woke up in his situation with his portfolio. So just real quick here, Goose's situation. He's 50 years old. He says, I've been working in my company for over 20 years. I've been putting 10 to 15% in those 20 years of my work's 401k with the Standard. I have them manage my funds since at the time I had no idea what I was doing or had any desire to learn. At the end of 2023, we got bought out by another company, so we had to roll over our monies. And at the end of the run with the old 401k, I had a total of $320,000. Hey, Goose, not bad at all. 50 years old, $320,000 already sitting there in retirement. Still plenty of time to let that sit and grow. So certainly off to a good start, let's say. Let's see. So our company uses Fidelity for their 401k and other investment accounts. Since I had a surface level understanding of investing, I had them manage 300,000 of it and took the rest and opened a traditional IRA and bought 4 Fidelity funds as my intro to doing it myself. I also opened a Roth and started putting $50 per check or $200 monthly. I do that through payroll and by FXAIX, S&P 500, and FSPSX International at 85% and 15% respectively, and have about 1,600 in there at the moment. So that's the situation that we've got here. I did do some additional probing questions because I wanted to make sure I really understood what Goose's situation is here. Guys, let me tell you something. Goose has no consumer debt, so no car loan, no credit card debt, no medical debt, nothing like that, and currently is living in a paid for house. So, if you've got that situation, then you can definitely put a lot of money into the market because your monthly bills are going to be pretty low. And all you've got to worry about is food and transportation, some insurance, just your utilities. I got to think that I don't know exactly what Goose's budget is, but I can't imagine that he needs to come up with any more than maybe $1,500 a month to cover all the basics. So great spot to be in, Goose. So let's take a look now at Goose's fund here. So he's got this fund, traditional IRA, 320,000-ish in it. So we got a lot of holdings here. A lot of holdings. So there's 27 holdings here, 26 total holdings. 4 of them are single stocks. So just to go and point them out, he's got J&J, Realty Income, Procter & Gamble, and Chevron. So great picks for 4 individual stocks. He's got 5,000 give or take invested into each of those. He's got 80,000 of his money sitting in basically cash, more or less, earning 5% or in FDRXX, and basically trying to figure out how he's going to allocate the rest of that $80,000. And I definitely respect not wanting to do it all in one fell swoop. If you're earning 5% on the cash while you're sort of learning and figuring some things out and doing a lot of self-instruction, no shame in just having that cash sitting on the sidelines. It's better to earn 5% on that rather than invest in something that you'd rather not be invested in and end up losing money. So the biggest holding that he's got is SCHD, far and away. That's sitting at 104,000. Looks like my formula on these top cells here are off. Sorry about that, Goose. Should have double checked that. Let's see. Yeah, that's about 30% of the portfolio. He's got 25,000 in VOO. So we've got nice combo there, SCHD, VOO. And then a couple of those Fidelity mutual funds that he mentioned that were kind of like a starting point. And then a pretty good collection of other ETFs here. We've got QQQM, Devo, SCHG. We've got a Fidelity High Dividend, Fidelity Real Estate, DGRO. Definitely like that one. iShares Core Dividend, JEPI. 2 more Fidelity mutual funds. Let's see, Vanguard Utility ETF. We've got a small cap ETF. Invesco High Dividend ETF. VYM, another high dividend ETF. We've got a couple of sector ETFs here in the healthcare and energy and consumer staples. So that's kind of the rundown there. So it's a lot of holdings, but almost all of them are ETFs. If you like to have a lot of different ETFs in your portfolio, I mean, I don't have any problem with that. I don't necessarily think that it's necessary to have a whole bunch of different ETFs. But at the same time, you've got tons of diversification with all of this. And, there's certainly no harm in having it set up this way. So, you don't necessarily have to make any changes to it as far as I'm concerned. There's not anything in here that you're invested in that I look at and I think, I don't even like that investment. That's either risky or silly or whatever. So, definitely off to a really solid start. Now, don't take it as advice, Goose, because again, I'm not a licensed professional. But if I woke up tomorrow with this exact portfolio at age 50, let's just, I wake up in your shoes, I would personally want to consolidate it a little bit. Because what I'm probably going to want eventually, because of my personal investing style, I'll eventually end up adding more individual single stocks when they are trading at a discount. So, like, for example, you're age 50. If you've been following the channel, you know that I set up 60 individual high-quality dividend growth stocks, split them into 4 different categories or tiers that are age-based. The tier 3 is for the 42 to 53-year-old investor. So I'd probably be looking at my own tier 3 and saying, hey, can I move $5,000 of that cash into one of those individual single stocks that's trading at a discount? So that way I can, pick up something really high quality while it's trading way down. And right now, Hormel Foods, stock ticker HRL, and Archer Daniels Midland, stock ticker ADM, are both absolutely in my personal buy zone. So that might be something that I'd be looking at with some of that cash. But if I wanted to do some consolidation, let's take a look here. So something I'd probably look at here is, let's look at the stuff in the red here. So you've got your semiconductors portfolio, you've got the Fidelity Contra Fund, and you've got the Fidelity Blue Chip Growth Fund. So these 3 mutual funds are all pretty growth oriented. I'm not a mutual fund expert. I don't know a ton about those, but I would probably take these 3 funds, since it doesn't sound like you were super excited about them anyway. I'd sell those off. That would give me 25,500 to work with. And then I'd put some of that money in QQQM, some of it in SCHG. Both are growth oriented funds. QQQM is going to track the NASDAQ 100. SCHD is going to track the NASDAQ 100, but not disclude financials. So you're going to have great stuff like MasterCard and Visa, stuff like that that's just not in the NASDAQ 100. I might even put all of it into SCHG. I think that one is superior to any of the QQQs. But if you wanted to, if you wanted to keep both of them, nothing wrong with that. But I'd probably consolidate down those three positions, put them in the other growth-oriented positions to give you three fewer. And then I'm not a big fan of sector ETFs, so I would take some of the higher yielding stuff like FDVV and HDV. I think that both SCHD and VYM just perform better than these two. You've got the Fidelity Balanced Fund. That's your fourth Fidelity fund. And then you've got your Utility Index, your Healthcare ETF, your Energy ETF, your Consumer Staple ETF. Because I don't invest in sector-specific ETFs, I would probably just go ahead and liquidate all 7 of these. That's going to give me a total of $35,600 roughly. I'd probably put some of that into VYM. Now, I would include SCHD in here too, but you've already got over 100,000 in SCHD, and that's pretty good. So we can kind of keep that where it's at, but probably pump up that VYM position now because you get a lot of diversification. You're going to get a lot of those same utilities and energy and all of that stuff. A lot of that stuff is going to be in VYM. There's over 500 stocks in there. And then you've got this really nice one in here that I didn't know a ton about, PEY, the Invesco High Dividend. This one's performed really well. It's a monthly payer, higher yield, 10 consecutive years of dividend growth. I really like this one, actually, when I was kind of going through and taking a look at all of these. So you maybe keep a hold of that one, split this up over VYM and PEY. And then you're going to have something that's a little bit more straightforward, kind of like this. We're going to take you down from 26 overall holdings to 16. You can fit it all here on one screen. I don't have to do any scrolling. Look how much cleaner this looks, Goose. This looks pretty good to me. We're still going to be working with that $80,000 in cash. You'll have your nice big old fat SCHD position here. You'll have a much larger VYM SCHG position, PEY, QQQM, VOO. You're going to have 5 figures in all of these. And then you can continue to kind of split out some of these. Devo for your age range, certainly not bad. Being in your early 50s, you get price appreciation and monthly dividends. I went ahead and kept your real estate ETF and your small cap value ETF, just so you have some diversification and exposure to those sectors. I don't see anything wrong with that necessarily. And then, I'd probably just be looking to add really high quality individual single stocks. And if you didn't want to mess around with that, then you could continue to just kind of gradually, move your cash into some of the other quality options in here, whether it be VYM, SCHD, PEY. You've got some good choices here, Goose. And then just one final thing, there was something right towards the end of the email when we were talking about your debt situation, Goose. You were saying that at some point, maybe in the future, you might end up purchasing another house, and you might use your Roth IRA funds to do that when you could withdraw them without penalty. I probably wouldn't do that because you're not going to get the same tax advantages with the dividends in this traditional account that you have here. So I'd probably use the traditional account towards the purchase of a house before I would use something from the Roth, because with the Roth I can get those dividend payments completely tax-free forever, which is great. So Goose, I hope this helped you. I hope it helped any of the other viewers sitting in here watching. Leave me some comments down below. Let me know if I'm off base on any of this. Feel free to give Goose some of your opinions as well. Links in the description to the 4 tiers videos below, and keep those emails coming, y'all. I really appreciate it.